First, I still believe gold and silver are going higher, particularly silver, which is anybody that knows Peter Grandich from just past a few months ago say, did Peter Grandich just say he was bullish on silver? Because I always treated it as second class to the gold itself in terms of ownership. Not that you shouldn't own it, but, there's been people for silver for decades and, it underperformed quite a period of time. However, early in the year when it got below 30, I flipped the switch and I became as bullish, if not more bullish on silver and gold. And I'll touch on that in a moment. But the first important thing is, so earlier in the year, after owning gold for as cheap as $1,300, when it got up to its highs or within $20 of the highs, I made a decision that the major producers now could do better than the physical gold price. Plus, gold needed to go through a very long consolidated phase because of how fast it rose in the previous 12 to 18 months. So I went into the major gold producers.
This could be your final warning before silver takes off. Peter Grandich, a man who spent decades favoring gold over silver, now says he's more bullish on silver than ever, and he believes we are just days or weeks away from the most explosive breakout in modern history. We're talking about a 31-year cup and handle pattern that's about to trigger, a setup that historically launches prices straight up. If silver clears $40, Grandich says we could see it race toward $100 or more, and once Wall Street and big money catch on, the move could be violent and unstoppable. If you've been sitting on the sidelines, this might be your last chance to get in before the crowd. In today's video, we break down why Peter Grandich flipped bullish, what's happening in the bond markets that makes this moment so critical, and why silver, not just gold, could be the trade of the decade.
Let's take even the biggest concern as you and I speak. The IMF is talking about a possible bailout of both France and the United Kingdom now. We've just seen yields in France double in a year at a time when central banks in general have been easing short-term rates. And that goes to the big, and also in Japan, which is probably worse situation than the UK and France combined. So here's the issue. These countries have eased or tried to lower or have lowered short-term rates, but their longer interest rates went higher. And people say, well, how is that? Well, first of all, just like here in the US a year or so ago when the Fed eased, short-term rates went down, but the long end went up 100 basis points. And the reason that's happening now is, and people can say, oh, you guys, Elijah, and those guys have been talking about years about the debt problem, and that's right. The bond market's telling you now it's a serious issue because they're concerned about the fact that easing and adding more money is going to make it even more difficult down the road, and therefore you're going to have to pay me a much higher yield to where real money goes, and that's in the long end. And remember this, all these consumer things, whether it's cars, mortgages, credit cards, they're all based on what long rates are doing, not what short rates are doing. And the Fed knows itself that it can only influence the short end. So the surprise, even if the Fed does act, which it's likely to act, that the only way the Fed would not act with an interest rate reduction in September if somehow the employment numbers reverse back up and they're not as bad, and this readjustment number that's going to come out is not as bad. Now, I don't think Trump's guy or folks are in there yet, so they can't massage the numbers back to the way he'd like to see it and so forth. But I do think they're going to cut rates, and the shock will be a year from now, even if they continue to cut short-term rates, that the long end could actually be higher than it is now. And that will cause much of a big problem. Now, the average investor is not looking at that yet, but I've been saying this for several weeks now, and I'll say it to your audience as well. I wake up in the morning and I don't see what the S&P futures did overnight as my first thing. I've seen what bond markets did around the world, because the bond market is far more important to our economic well-being or lack of well-being than the stock market will ever be. First, I still believe gold and silver are going higher, particularly silver, which is anybody that knows Peter Grandich from just past a few months ago say, did Peter Grandich just say he was bullish on silver? Because I always treated it as second class to the gold itself in terms of ownership. Not that you shouldn't own it, but, there's been people for silver for decades and, it underperformed quite a period of time. However, early in the year when it got below 30, I flipped the switch and I became as bullish, if not more bullish on silver and gold. And I'll touch on that in a moment. But the first important thing is, so earlier in the year after owning gold for as cheap as $1,300 when it got up to its highs or within $20 at the highs, I made a decision that the major producers now could do better than the physical gold price. Plus, gold needed to go through a very long consolidated phase because of how fast it rose in the previous 12 to 18 months. So I went into the major gold producers. Then, when they did as well, and they're going to continue to do well, they're basically record amounts of free cash flow in the sense they're printing money. The bottom line then was, well, the next order of business is, you know, you have all these folks on Wall Street telling us about AI and all these centers and all these needs. Well, they need two things. They need electrical power, which we have a huge problem. You know how I feel about the grid and the inability to deliver power. But it also is going to need a whole bunch of metals. And that's why, you know, another metal that I like very much is copper. But there's been such a lack of worldwide exploration for these metals. The world has shrunk to where companies are willing to go because of economics and social and political causes. So I backed up the truck, so to speak, in the most riskiest of the type of stocks, what we call junior resource stocks or exploration stocks. But I want to say one thing about it. Gold and silver are just trading the best you could expect at this point in time. And as you and I speak, they're both on the verge to run, but the one that could really run, and again, I have to check my mouth that I'm actually saying this to you, I think silver is going to explode to the upside. As this chart I know you're going to show, going back 50 years in silver, there's been a 31-year formation of what we call a cup and then an 11-year handle. Now, if you remember a couple of years ago when you and I first started speaking, one of the bullish things about gold back then when it was under 2000 was it had an 11-year cup and handle formation that was ready to be taken out. And cup and handle formations 8 out of 10 times break to the upside, not to the downside. Well, silver, as you and I are literally just about to break out above the handle, which at 40 or more would clearly break out. Taking that just from the technical aspect of that, you could argue from that formation minimally, and I say this minimally, and I'm watching myself say this, Elijah, thinking I can't believe Pete Grandich is saying this, but I think silver could be triple digits. That means it's going to go to $100 or more. And so I'm real excited here. People need to know it if they don't know me. I've never been a silver bug. But I really think the time has come, and I really, think it's well. And even to the point that in your business of ownership, not only would I consider 50% ownership in the physical ownership, I might even overweight it in silver right now. So I'm about as bullish as I've ever been, ever, in the combination of both gold and silver.
Peter Grandich begins by admitting that earlier this year, when silver dipped below $30, he flipped from being a lifelong gold-first investor to becoming outright bullish, even saying he might now overweight silver in a portfolio. This shift is not based on hype, but on hard fundamentals and powerful technical signals. Gold had a massive run from $1,300 to near record highs, then entered a natural consolidation phase. Instead of sitting on physical gold, Grandich rotated into major gold producers that are printing money with record free cash flow, offering leverage to gold's eventual next leg higher. But while gold consolidates, silver is setting up for what he believes could be its biggest breakout ever. He highlights a rare technical formation, a 31-year cup and an 11-year handle, now sitting right under breakout resistance near $40. Historically, such long-term patterns break to the upside 8 times out of 10. A clean break could send silver into triple-digit territory, $100 or more, attracting momentum traders and institutional money. Beyond the charts, Grandich warns that the real crisis is building in global bond markets, not stocks. He points to the IMF discussing potential bailouts for France and the UK, soaring long-term yields in Japan, and the risk that even with central banks cutting rates, long-term borrowing costs could stay elevated, choking off growth and pressuring debt-laden governments. Silver's bullish case doesn't stop at macro risks. Industrial demand is exploding, from solar panels, electric vehicles, and electronics, just as global exploration budgets have been cut for decades, leaving no major above-ground surplus. This is a recipe for a supply squeeze. Grandich says fewer than 2% of investors own any gold or silver. If that number doubles, the inflows could be enormous, potentially igniting one of the biggest wealth transfers in decades. Add in weakening stocks and crypto markets, and the setup for precious metals looks stronger than ever.
Fundamentals are clearly better. See, there was always an excess 20 or 30 years ago. There isn't that excess now. And the other thing is it has so much more demand and usage from an industrial usage. It's still not a monetary. I know there's a few people try to argue that. The central banks are not buying it in any large quantity, although out of the Middle East, we've seen a significant purchase, and that may be changing. The ratio is another reason it got way out of whack. Not that it has to be any certain ratio, but if you're going to use historically, it seemed to be favorable. And then it's just that chart. I mean, that chart, there aren't a lot of technical charts that have outstanding 8 or 9 out of 10 times it works a certain way. Cup and handles, especially the longer they are, have about an 80% correlation of that when it breaks the handle to the upside, they go up substantially. So all those things combined, and throw in the fact that the things that have been competitive against gold and silver, the stock market and crypto, they look like they're peaking. So 12 to 24 months out, they could be in a much better environment than they did previously. And I will tell you this, if we're right about the technicals, I'm not saying it's gonna, but if we're right, we're going to see momentum players show up. And when momentum players show up and the charts really take off, then all these generalists are going to get calls from their institute. How come we don't own any silver? What can we own? And you know how I know that? In the last 3 weeks, maybe the whole month of August, I heard from 10 people that I haven't heard from in 10 or 20 years. In fact, they thought I was already out of the business because I left the metals and mining business in 2013. But they saw me somewheres and all, and they're starting to go, hey, I'm starting to hear from people that know what they're talking about. What are you looking at? And I just think if we get this breakout and it's being talked even in the general financial media, the fundamentals and the supply and demand argument is so bullish. So that's why I'm so optimistic. Let me add this before your time runs out, Elijah. This is critical because this is how some people think right now, even people that are bullish on the metals. I hear this a lot. I don't mean directly to me, but I hear that with people speaking online or whatever the case may be. Well, gold's moved up a lot. How much further can it go? How could it possibly go to 5 or 10,000? So when I first thought about coming in the early 1980s, when I effectively became a stockbroker in March of 1984, the Dow had gone 13 years trading between 700 and 1,000, to the point where in 1982 or 83, Business Week ran a front page story, which everybody on Wall Street spoke around, called "Equities Are Dead." They literally, along with many others on Wall Street, viewed that just because of everything that was happening in the world and how bad things were, and Russia and the United States are going to blow each other up, Japan was going to take over the world back then, yada, 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 the Middle East. They didn't think it was possible for the Dow to go much above 1,000. And then a young man who ended up helping me a lot early in my career, who no one heard of beforehand, came out of Gainesville, Georgia, named Robert Prechter Jr., with something called the Elliott wave theory, which no one was familiar with. And said, the Dow's going to 3,600. And the few people that put them on financial shows, they just put them on like you were putting on like a clown to show what an idiot this guy. How could the Dow go to 30? I remember people going, sir, how could it's never been above 1,000? And he would give the reasons and so forth. It went a lot further. It took decades, but it went a lot further than 3,600. And so I think it's a mistake to just simply say gold can't be 5 or 10,000 because it traded for so long between such and such a price. We have no idea or argument about that and so forth. Just recognize that right now, the vast majority of people, certainly in North America and particularly in the United States, don't own any. None. Not a mining stock, not physical bullion, nothing. And if that 0.5 or 1% or wherever it is, it's somewhere in that range, just switches to 2% of their portfolio, the numbers are incredible what they can get to. So that's another one of the many reasons I think it's still important to stay very constructively bullish on precious metals.
Peter Grandich isn't a silver hype man. He walked away from the mining industry in 2013 and has never been a silver bug. So when he says silver could break $100, it's worth paying attention. If you own gold or silver, this could be your wake-up call to check your allocations. Should you hold a 50-50 split or even overweight silver like Grandich now suggests? And if you don't own any precious metals, is this the last chance to buy before Wall Street piles in and drives prices out of reach? Let us know what you think. Will silver hit $100 in the next 12 to 24 months? Drop your thoughts in the comments below. And if you want to stay ahead of this historic move, make sure you like this video, subscribe, and hit the bell so you don't miss the next major update.